Hey, I'm Abe, and today we're going to talk about mutual funds. We've been talking about it in reference for the last few weeks, and now is the time we're here. Mutual funds are a pool of money from a bunch of investors like you and me that are then used to buy a large collection, and generally a large diverse collection of securities, which are like assets of stocks, bonds, that sort of thing. A mutual fund may be invested in hundreds of different companies at any given point in time. They generally have a target or a theme, a specific goal, whether it's small cap stocks, large cap stocks, energy industry, high tech, whatever it is. It's usually a very targeted and specific fund. The value of mutual funds depends on the performance of those stocks and bonds and generally the investments that are made within that fund. Unlike directly investing in a specific stock, mutual funds do not give you any voting rights. So even though the mutual fund that you're invested in has a portion of it invested in Google, you will not be receiving any shareholder meeting minutes or notes. You won't be voting in any of those meetings either. So instead of investing directly in a single company, investing in a single mutual fund allows you to be relatively diverse and invest in a bunch of different companies all at once. So one share of a mutual fund gives you a certain very small percentage of an investment basically in all of the companies that fund is invested in. The price of mutual funds is determined by and referred to as the net asset value, or the NAV. Basically, that's just dividing the total value of the securities in the portfolio by the total number of shares outstanding. Unlike stocks, the value of mutual funds does not fluctuate throughout the day. There is an assessment at the end of trading, and that's what the value is set at. We're going to get into advantages and disadvantages. So the advantages is, like I mentioned before, it is a relatively diverse tool to invest in because you're not investing in a single company, you're investing in hundreds of companies for each mutual fund that you might invest in. It also gives you easy access to difficult to reach markets like foreign or international markets, exotic commodities markets, and other things like that you may want to invest in, but you don't have access to through your regular brokerage account. It offers you high liquidity because these mutual funds are sold and bought on a daily basis, and you can just sell them out, get your money back within a day or so, and you're good to go. There are good economies of scale. When we've looked at brokerage accounts in past videos, we've talked about how there are often trading fees that are associated with these investment accounts. So each time you buy a stock or a mutual fund or a bond or something, you're charged $7 or $10 or some small amount. If you wanted to achieve the same diversification that a mutual fund gives you, and you wanted to invest in 500 to 800 different companies that you had handpicked, that would cost you $7 or $10 for each transaction of those 5 to 700. So it adds up extremely quickly. But with a mutual fund, you can buy a large chunk of mutual fund shares, pay the one trading fee, and then have the exposure to hundreds of different stocks within that fund. Mutual funds are also professionally managed. So there is it's like a company. There is basically a CEO or a fund manager or a team of managers, a bunch of researchers and analysts that support them and are informing them on what companies to invest in, what companies to divest from. This is their entire job, is making this fund a successful fund and growing it over time. As I mentioned before, another advantage of mutual funds is the large variety of options available to you, and not just a variety in everybody's got a mutual fund that they're trying to improve and increase the value of, but that there are different markets and areas that each of these mutual funds is targeting, whether it's small companies or large established companies that are only in Japan, or large companies that are tech focused and only in China, or there are a lot of very specific options to choose from, and it gives you a huge variety for your investing diversification. And then lastly on the list of advantages, and this is by far not an all-inclusive list of advantages, is transparency. Like many investment tools and vehicles, mutual funds are subject to regulation, and they are required to follow and provide as much accountability as they can to each of their investors. What about disadvantages? So disadvantages sometimes are overlapping and share a handhold with the advantages. Because it is a managed and a professionally managed fund, usually this is how it works. There are a bunch of people whose jobs it is, and whose, I won't say their entire lives, but whose professional lives revolve around creating and adding value to the fund. These people need to be paid, and as such, there are fees and commissions and general expenses associated with each of these funds. There are also often large cash presences in a lot of these portfolios. Now, it's not cash that you can then go in and get your hands on by any means, but they have to hold a lot of money or a lot of their overall portfolio in cash for a couple reasons, or at least a couple key reasons. So the cash is there for liquidity reasons, and it is also there to act as a somewhat counterbalance for the risk that they are taking in investing in a lot of stocks. Having a small portion of your portfolio as an investor, and this is true for mutual funds, sitting in cash is a good way to add some level of diversification to your portfolio, because no matter what the market does, or no matter what you're invested in, bonds, stocks, tech stocks, if the tech market goes up or comes down, if the bond market does well, if the entire market, including bonds, is doing poorly, your cash, with the exception of inflation or deflation, your cash's value won't change. And so it acts to offset some of the volatility that you would see in the market. In the same way that you might want to keep some in cash for your emergency fund and just as a good diversification tool, so too do the mutual funds. Why that's a disadvantage is because it's not out earning interest itself, and it's not out being invested, being a useful tool in that way. So that money isn't growing, which means that a similar portion of your investment in the fund is not growing because of that, but it is a good diversification tool. So you got to take the good with the bad. There is no FDIC coverage. So unlike having money in a bank and having up to $100,000 of that insured, there is no insurance for your mutual fund investments. Like many investing things, this is a risk that you are taking by choosing to invest in them. Because of the information that's available or not available online, it can be difficult to compare one fund to another. It can also be a little difficult to figure out exactly what all a fund is invested in, what specific companies. You can go to a website, and I'll show you one at the end here, and see a little bit of what they're invested in, like their top 10 assets in as far as the greater percentage of what they have invested. But seeing an exhaustive list is a little bit difficult to do. It's also easy to become non-diversified or undiversified when investing in mutual funds if you're not paying attention to what it is that they are invested in. So I might have 3 or 4 different mutual funds that I think are great that I want to invest in. I think all 3 or 4 of them are all invested in hundreds of different companies. So of course I'm going to be diversified. But when you look at their holdings, all of those funds may be invested, at least in their highest percentage of investments, in the same 5 or 6 companies. They all may be invested in Google, Amazon, Apple, and some other core, large and well-established companies because they're good investments. But if you're looking for diversification and you're thinking you're getting it, you can sometimes slip up and end up making things less diversified for yourself by picking funds that overlap with each other. Lastly, and again, this is not an exhaustive list of disadvantages, but things to keep in mind, is taxes from capital gains within the funds. Those are passed along to you. Before we get to looking at one fund in particular, just to show you an example, there are some costs that are associated with owning mutual funds that you need to be aware of. One we just talked about, which is taxes, and another, and the sort of the main and primary one, is fees that you might experience owning mutual funds. And by fees, it's referred to as the expense ratio, and it represents how much of your invested amount will be taken out in fees each year. And it's gradually throughout the year, so you can't invest up to a certain point, pull out your money and avoid the fees, and then reinvest, and you'd be fine. That's not how it works. So generally, or on average, Investopedia says that the expense ratios range from 1 to 3%. I found that 1% is more kind of in the average of the funds that I look at, and I probably am not looking and also considering funds that are charging me more than 1%, at least not much more. Maybe 1.25% is as high as I will go. That's personal. That's just what I've chosen to do. Fees and the expense ratio is something you should pay attention to. There are loads on some mutual funds, and we're talking front-end load fees, which is a chunk of money that you are going to be assessed when you buy purchases. And then there's the back-end load fees, which are fees that would be assessed when your shares are sold. There are a huge variety of funds that are available that are no load, that you won't have to pay just to invest in. But there are also potentially fees that you may need to buy that aren't listed on any of the mutual fund rating sites that are associated with your brokerage account. So if you're invested in a Fidelity account, some mutual funds may be outside of their network of funds. And in order to access and purchase them, you may have to pay a larger fee, maybe $75, just to get access to this fund that is outside of their network. We've covered the advantages, the disadvantages, the costs. There are multiple different types of mutual funds that have different goals. There are equity funds, fixed income funds, index funds, income funds. There's a long list, and we could spend a lot of time going through those. But just know that there are targeted and very specific purpose vehicles for each of these funds, and you can find pretty much anything that you're looking for. So let's go take a look at the example. On Investopedia's page, which I've linked down in the video description below, it mentions Fidelity Magellan FMAGX, which is obviously a Fidelity mutual fund. And I just pulled it up because it was, as good as anything else. So looking here, I've opened it up in Morningstar. They've got the net asset value that we talked about, 10.82, at least as of this recording. Total assets under management is 18.6 billion. Here's the expense ratio we were talking about. And like I said, it's less than 1%. It's 0.77. Fee levels are below average, no load. And when we were talking about capital gains and taxes, turnover is an indication of how many times or how much of their overall investment they are turning over, how much of it they are selling and buying new. And that the higher percentage there will tell you the higher percentage indicates a higher tax burden that will come along with investing in this specific account. The category is a US specific fund with large growth. And you can see on the investment style box that a lot of these pages use that's in the large growth area. We can see what industries they're invested in and what percentage of the fund is invested in each to give you some idea of where your investment is going or what you will be exposed to. And as I mentioned before, you can see the top 10 holdings within this mutual fund: Microsoft, Amazon, Apple, Facebook, Visa. This shows you what kinds of companies that they would be invested in. So this is mutual funds. This is a great tool to add to your toolkit for investing and saving for the future. It offers all the advantages that we talked about. It has some setbacks or disadvantages, but I think the advantages outweigh the disadvantages, and they really should be considered as a tool for you to save for retirement and just in general to build wealth. Next up, we're going to be talking about exchange traded funds, or ETFs, and the difference between those and mutual funds will be they're somewhat similar, but with some key differences. So stay tuned. Thanks for watching, and I will catch you next week.